Hey everyone, me Kevin here. Let's talk a little bit about TOST and the TOST IPO that just occurred. So TOST is a payment processing platform and a terminal platform that is geared towards restaurants. Obviously, a big competitor here is Square, but it's not just Square. It's also going to be other competitors like Zoisk, which is another payment processor. And so a lot of competitors in the space. It is a competitive space, which makes sense. What we're going to do right now is we're going to look a little bit at their valuation. We're going to look at their S1 to kind of compare some of their revenues and some of their spending and margin to companies like Square. It is always difficult, though, to perfectly compare these companies since every company is different. For example, while Square is a payment processor as well, Square helps small businesses manage their inventories and collect payments for all sorts of different companies, not just restaurants, where a TOST is specifically gearing towards restaurants, maybe catering their services a little bit more towards restaurants. They also do payroll services, which is worth mentioning. You've got the company being co-founded by three people who used to two people used to work for Oracle, which does a lot with software services. The goal really of TOST, the company says, is to digitize the restaurant experience, which you see this at even individual companies. And this is worth noting as well. Dave & Buster's, for example, they're making their own platform and they've released sort of their own payment processing platform so that when you sit down, you scan a QR code and then you check out sort of on the Dave & Buster's website and go through their terminal and their sort of portals, which that's going to end up being one of the risk factors for TOST that we'll talk about here. In fact, I'll just give you a preview right now. They, on average, have about 1.7 restaurants per company that they work with, which that is a big red flag that you're really scaling towards smaller, more mom and pop potential restaurants where, maybe they've got 1, 2, or 3 locations, as opposed to scaling into some of the bigger, larger chains. However, that could also be a good positive indicator for a company like TOST because you're very well diversified. And imagine if you were the processor for a company like Cheesecake, and then all of a sudden you lost that contract and you lost thousands of restaurants at once. But I do think the big chains, they're the ones who are investing in the technology to create their own payment processing systems. Again, like Dave & Buster's does their own. Cheesecake has Cake Pay. They do their own. So maybe that's not even necessarily a bad issue for TOST. These companies, they're just going to go with their own payment processors. It's really the smaller, maybe mom and pop restaurants that you're going for. Worth keeping an eye on. So again, their purpose is to provide turnkey solutions for restaurants. They're raising about $870 million in cash for themselves here. We've got about 400, just under 500 million shares outstanding, which actually makes the math really easy for when we look at the stock chart on this one. Because when it's trading for about $60, you could just multiply that by half essentially, and then call it billion, and then you get about a market cap. So right now we'd be at about a $30.5 billion market cap. It's about $10 billion more than Affirm, the buy now, pay later platform that's got a partnership with Amazon. It seems a little rich initially when you think, oh my goodness, the restaurant, the mom and pop restaurant payment processor is selling for a $30 billion valuation, but that is what it is. Right now, about less than 10% of their revenue comes from subscriptions. A good chunk of their revenue, closer to 40%, which we'll pull up those numbers right in just a moment, comes from actually being the payment processor. And this is kind of being that terminal where they get a 2.69% fee anytime somebody's swiping that credit card or debit card to pay. So payment processing, big portion of their income right now. They've got here's the number, 29,000 customers with 48,000 locations, which shows you that you're really let's do the math here really quick. Just do 48,000 divided by 29. That puts you at, I had said earlier about 1.7, puts you at about 1.65 restaurants per customer that they have. Annualized recurring revenue at $494 million. This is a really important metric that you want to look for, especially in software service companies. Usually these companies, they don't make a lot of money off the hardware. They're making money off the fact that they're processing payments, and then they're trying to make money on those subscriptions as well. The company is still losing money. It's a smaller company. It's worth noting that it's selling for about 21 times well, actually, let me pull up the numbers here just to verify. We'll go through them here together really quickly. So take a look at this. This is the S1 for Toast, and I'm going to compare parts of this in just a moment here to Square. So let's do this together here. Let's go ahead and pull up their specific revenue sheet. Give me 1 second to get to it here. I misplaced it. Hold on, give me 1 second. So we're going to pull up the revenue, and specifically what I want to do is I want to compare their transactional revenue so that we can get a good look and compare this to Square. And so here's Square. Here's the transaction revenue for Square, just so you can get an idea. We're going to look at the 6 months ended on June 30th for Square. We're going to do a similar look here for Toast. So for the 6 months ended June 30th for Square, we were at about almost $2.2 billion of transaction-based revenue. And you can see that's a pretty high margin here at Square. So at about 1.22 is the cost divided by 2,187. Looks like you've got costs of about 55%, so margin of about 45% on transaction-based revenue at Square. And we're going to go ahead and compare this to the revenues that we've got over here. 6 months ended June 30th. They call transaction-based revenue financial technology solutions. And so here you can see financial technology solutions are about 579 mil. So obviously for about a fourth of what Square is doing, which makes sense. It's a much smaller company. And their profit isn't as high yet compared to a company like Square. Remember, Square is taking about 45% of that transactional revenue to the bottom line. Over here, we're closer to, let's divide this here really quick just to get a percentage. We're closer to 22% coming to the bottom line on those transactional based revenues. So a little lower margin. We've got a lower scale, but of certainly amount of transactional revenues. 579 million. If we were just to value the company solely off of this at an annualized rate, let's do that. Let's do 580, let's say, times 2. That'd be about 1.16 billion of transactional-based revenues. Right now, they're selling for about $30.5 billion. That would put you at about 19 times their transactional revenue is approximately what they're selling for, ignoring like hardware and subscriptions. The reason I'm specifically ignoring that is because over at Square, you got to keep in mind you've got things like Bitcoin revenues, you've got hardware revenues, which are a loss leader for both Square and Toast, and 21 times transactional revenue. If you take that same annualized number here, that'd be about $4.2 billion for Square. Square's got a market cap of about 120. So 120 divided by 4.2 puts you about 28. So if you actually on a transactional side, you're paying more at Square than you are for Toast just for those transactions. Now, total revenue is a lot higher at Square, but you got to be careful at Square because look at this. A lot of the revenues that are coming into Square are coming in from Bitcoin revenue. And you'll notice here, Bitcoin revenue might be $6.2 billion, but Bitcoin costs are 6.1. Very, very, very low margin. So looking at this actually from transaction-based revenue, you're paying a lower multiple at Toast. I will say $30.5 billion still seems incredibly expensive. For a restaurant payment processor that's not going after larger chains. But then again, hey, neither is Square. Square's not trying to go after like the Macy's of the world. They're trying to get into all those small businesses. So worth keeping an eye on this. We've got some other things to cover here in just a moment. The stock technically it was supposed to IPO at $40. This is strategic. Generally, you'll see these sell for anywhere between 50 to 80% above that. It is up about 50% right now, though it is off of its highs. Did run to a high of about 65.97. Still think, again, a little bit rich on valuation side, but comparing to Square, hey, Square's not exactly a cheap one either. So let's go through some of the other things that we're seeing here. One thing that I found very interesting when I first went through this S1 here, or their public filing, is they're spending a lot of money on sales and marketing, but they're growing at a faster rate. So watch this. They had in the first 6 months ended at June 30th. So the first 6 months of this year, they got about a total of 703 million in revenues, and they spent on that just about 10%. They spent 73.8 divided by 703. So they spent about 10.5% on their marketing to get to the 703 in revenues they have now. Previously, if you go to the year ended, for example, 2019, you had 129 million of marketing expenditures and revenue of 665 for the year. So you were spending about 19.3% on marketing. So either their marketing's gotten a whole lot more efficient, or they've become a lot more like known in the small business community to, or potentially they're getting just more recurring revenues. It's the other thing too, right? You sell the machines in 2019, you get more terminals in. It takes time to get these terminals in. So their marketing dollars appear to be going further now, but this also does make sense for a subscription-based company. And this is very common. What you find with subscription-based companies is the goal is just lose as much money basically as possible up front so you can acquire more customers. And then you could essentially keep growing that annual recurring revenue base, which right now is around 500 mil, which is really incredible. So hardware, they lose money on their hardware, very normal. It's essentially a loss leader. Subscription services are very profitable. This would be like inventory management or payroll services. This makes sense. The more of these they can sell, the more they can get like 3x the profit margin, right? Because look, you're getting $68 million in subscription services, and it only costs you about $23 million to run that. As the company scales in revenue, this will grow. Now, in terms of we can't really do like an EPS. We could do projections in terms of growth rates, which I don't know that we have forecasts right now. We'll do a peek around to see if we have any kind of forecasts or any kind of guidance in terms of where they expect to go. But let's peek around a little bit more at some of the highlights of the company, just so we can get a little bit of a better understanding as to what we're looking at here. So, at the beginning, one of the reasons usually I discard kind of the charts that they're showing you, but one of the things I like looking at when you look at some of the earlier portions in the S1s is they let you know what's important to their company. So you've got a little bit of a backstory here in the S1. They talk a little bit about the industry, talk about COVID and the reopening, the opportunity, how many restaurants they could really get into. I would be careful with this. How many restaurants they get into, in my opinion, is a little bit misleading, or this total addressable market, because they're not going to get into the big retailers, the Dave & Buster's, the Cheesecakes or whatever. These folks are making their own proprietary platforms here. So this omni-channel experience, this is very similar to what Square does, where essentially they can do that inventory management. You could sell in-store, online, right? That's very important. Cross-channel, super useful. I love comparing them to PayPal. Their point-of-sale machines, by the way, which I think is cool, also accepts or creates gift cards. Gift cards, by the way, great way for restaurants to make money, especially since gift card redemptions are always like 85 to 90%. So it's kind of like, or sometimes even less. So to me, it's kind of like getting free money, because, you sell $1,000 of gift cards, you're probably only going to have to provide like $850 to $900 of services. Those leftover pennies and dollars never really get redeemed on gift cards, which I think is incredible. But yeah, increasing the adoption of the full suite of products. This is something that is really a profit margin driver, but the biggest driver is how can you get more customers right now? And then that comes over time. That's always the goal of a company, is to try to get customers spending more money, the customers that you already have. The problem with that is it's very difficult to do that. It takes time. It takes more selling, sort of the upselling. It's effort, right? Okay, so let's see what we can learn here. So we've got annualized recurring run rate to calculate the metric. Okay, let's see. MMR design include fees. Okay, so free cash flow. We got some free cash flow, about $38.8 million. Risk factors. We're gonna risk factors are useful. We may not be able to sustain their growth, so this would be useful. We might be able to get some guidance here. All right, let's look at this here. So in the years ended 2019 and 2020, our revenue was $665 and $823 million, representing a 24% growth rate. In the 6 months ended June 30th, and in 2020 and 2021, our revenue represented a 105%. You can't do this. See, this, you have to be careful. Some of these, in my opinion, are misleading. Their revenue, obviously, in 2020 is going to be a lot lower than and you're comparing into a whole, right? So I think it'd be more effective to take half of 2019 and say in 2019 you had about a $330 million 6-month growth rate. 330 to 703 in 2 years is what you're trying to do, right? So if I just do 330 times, I don't know, let's go with like a 1.4 and a 1.4. Let's do that twice here. Yeah, there we go. We're getting pretty close. 40, yeah, it's like a 47% growth rate. Yeah, closer to about 46% growth rate. All I'm doing here is I'm taking the 2019 first 6 months, just dividing in half here, multiplying by about 46% for 2 years to get to 2021, which is where our revenue is approximately now for the first 6 months of the year. And this is a rough estimation, but it shows you about a 46% growth rate is what they've had. Yeah, hey, that's bigger than the growth rate they had between 2019 and 2020. But again, it's hard to compare to 2020. Okay, 2020 as a whole, so you really want to try to get out of that. But hey, if the company grew at even 30%, for the next few years, I think that's great. Because let's do that here quickly. If you're at 1.4 annualized for the year, and you grow at 1.3% for 20, say that's 2021, 22, 3, and 4, you'll be at $3 billion in revs by 2024. You should be profitable then, especially if you could reduce some of these costs as a percentage of what they're spending. We're on a good trajectory with sales and marketing. And I would expect they'll at some point be able to start slowing down on research and development. The fact that they're still spending 10% of their revenue on R&D, I mean, it's not unusual to spend 10 to 15% on R&D, but they're spending a lot. I mean, they're at an annualized rate of almost $150 million here on R&D. And so, hey, maybe they're just always innovating for new products, which you kind of have to do in the tech space. So maybe we'll let that one fly. Let's see what else we have. So, okay, let's see here. It's definitely going to be a company that you want to see a lot of growth in. Sometimes what I like to do is also take a peek at some of the trends, like how many people are looking for the TOST POS. I think that might be worth looking at. So if we do like a quick little trend search here, let's see here, TOST POS. Let's see if anybody's looking at that. It actually does show up with search results, which is good. You go over the past 5 years. Yeah, you've got a nice trend up here for the TOST POS. Point of sale. Look at that TOST POS support pricing. Pricing, that's always a great term to look for. Although this is going to be a lot harder once you start getting too specific. Compare, let's say, the TOST POS to the Square POS. Let's see how those search trends are. So over the past 5 years, they kind of look like that they've somewhat been growing together, which is kind of good. The fact that the comparisons here are so close is impressive. Yeah, look at that. That's impressive. That we're so similar here on the trends. Or they're looking at TOST being a POS. Yeah, I don't know about that one. Okay, let's see what else we can find in their documents here. So again, on a sales basis, I personally like looking at transactional based revenue, and when you compare it to Square, they're actually not too bad. Problem with Square is they put all those Bitcoin revenues in there, so if you use the total revs, things get skewed a little bit. All right, let's see what other sheets we could find here. Okay, a little bit longer as well. It's an interesting. Here we go. Net retention rate. We measure the annual net retention rate by an average. Okay, for the years since 2015, our net retention rate has been 110%. Basically, so what this means is they're growing how much they're selling to their customers rather than losing customers. It's bad if you get under like 90% because then you're losing customers. That would be your customer-based churn. And in chronological order, they were at 119, 122, 114, 110, 114. That's great. I mean, this is very stable retention, so that's good. Again, I question a little bit the valuation. I think $30 billion is a little bit on the high side, but people are very excited about IPOs right now as well. And sometimes that IPO euphoria is, you know, is something to be mindful of, how many people are trading it, right? But this, I think, is not something that I would really count heavily on here. As customers grow their businesses and open new locations, we expect to see corresponding increases in locations per customer, basically. I don't know about that. They got like 29,000 customers. They're at 1.65 per customer right now. I mean, sure, that would help, but I don't know if that's where the real growth is going to come from. I think the real growth comes from how many small businesses can you attract? How many small business restaurants are there? How many small business restaurants in United States? That would be interesting. Let's take a peek at that. So restaurant levels, National Restaurant Association. So we have restaurant opinion. Okay, here we go. So restaurants temporarily or permanently closed. That doesn't help us. I'd like to know how many there are total. All right, well, how many number of restaurants? So total number of restaurants in the US, 660,000. But what we really want to know is how many small business restaurants there are, not chain restaurants, right? How many small, what if I just put small restaurants in? Okay, as of December 2019, there are more than 490,000 total independent restaurants in the United States. That number's probably shrunk through the pandemic. So even if you took 30% off of that number, that's still a good market that you can address. So take off 30% here, 343,000 potential restaurants. They're at 40-ish thousand. I mean, they're only, what is that? 8%. 40 divided by 343. It's about, okay, well, 11.6%, right? Not 8%. That's about 11.6% that of market share of maybe small businesses that they've taken. It's interesting. They've got a lot of growth or room to grow. But again, how much is it going to cost to get the small businesses? How much competition is there for those small businesses? They're not going to get everybody, right? All right, let's see here. Hardware costs. Hardware, they don't make money on hardware. I mean, tiny little bit, fractionally. These are year results for last year. We care more about the details here. So G&A expenses increased 36%. The increase is primarily due to allocated facilities and depreciation expense, mostly related to one-time lease buyout transactions. So I like that. Anytime you see large increases, like large spikes in one-time expenses, that's good for the future because the future should then be more profitable. Warrant liabilities here, $8.2 million. I mean, but all in all, not too much here as a percentage of their G&A. Okay, so let's see if we can find anything particularly else. I made some notes for other notes here, but nothing. Let's see here. All right, financing activities. Yeah, okay. A lot, obviously, to digest with Toast, but loan servicing activities, specific. Okay, more disclosures, share-based compensation disclosures, portfolio credit losses, because they do loans as well for their customers. All right. So response to COVID, and they've got their pamphlet over here, their competition. That would be interesting. Is I want to see what they declare their competition. Let's pull that. Our competition. Here we go. So see, here are other companies that you can compare to. So primarily compete with Square, Touch Bistro, and the Clover Network, and Lightspeed POS. So Touch Bistro, I wonder if they're public. Probably not yet. But this was the concern that I opened up with for the company too. Mm-hmm. Hold on one second here. Okay. So buy or sell, Touch Bistro. Okay, this is just equity sense. So it's still private. But you've got a lot of competition. Let's see here. Touch Bistro, Clover. Let's compare the trends on Touch Bistro, Clover Network. And let's see here. Touch Bistro. It's interesting to me. Touch Bistro POS. Wow, that's tiny relative. I don't know if, I mean, they have a POS? Touch Bistro. That almost seems off. Let's see if they have a POS. Yeah, they have a POS, and so does Clover. Let's try Clover or Intuit POS. Lots of competition. Clover POS. Clover POS is pretty close. So that's a pretty big competitor. Intuit, not even close. So Clover POS. Clover. I wonder if they're public. I don't think they are. But let's see here. Oh, parent organization Fiserv. Really? Okay. So this Fiserv here is public, and they do a lot of the old POS systems as well, and the company has been trying to evolve with Clover to do more modern POS systems. But Fiserv was like the traditional old stuff you'd see at like Kohl's or the retailers. I wonder what is probably much lower, but their growth is also probably much lower. I'll pull them up quickly here. Let me see here, Bloomberg. Micros POS. That's the thing, is there endless versions of these terminals. All right. That's why I wonder just the unique selling proposition of like a TOST relative to some of the others. Okay, here. All right, we're gonna pull this up, and we'll wrap up with some closing thoughts on it. All right. Okay, terminal coming up, and let's see. In the meantime, the stock itself on the TOST IPO, obviously the TOST, they always look like they're doing really well because they always underprice them. But looking at the sticks themselves, they are kind of doing a little bit of that sort of slow bleed here. But hey, IPO day, it's normal. This is the minute chart. This is what Robinhood looks like on the day chart for what it's worth, right? Okay, let me get Fiserv really quick. So I just want to get their numbers, because that I think is going to be an interesting comparison. It should be a much slower growth company though, because they've been around so much longer. Okay, so Fiserv has a $72 billion market cap. See, they're only expected to grow at 5 to 7% a year. They've got somewhere around $15 to $16 billion of revenue. So much larger company. Nice margin though, expected to be around 23 to 25% net income margin. So you got a profitable competitor here in Fiserv, but I don't know if you could compare them just because you're not, you've got Clover, but it's still going to be a smaller portion of their business. That would be another company though that I would compare to if I was really looking at TOST and I was super interested in TOST. All right, let's see what other information we have here. So, all right. Freedom Pay, IP. Okay. All right. Yeah, the rest is disclosures here, stock-based compensation. So this gives us a little bit of a look into them. Look, I love what I'm seeing in terms of their ability to market themselves. Love what I'm seeing in how they're getting more revenues per marketing dollar that they're spending. I like that. Their transaction-based margin is nowhere near yet what Square is taking home. They're 22% versus about 45% over at Square. However, as a sales basis in terms of how much like their valuation versus Square just for transaction-based revenue, they're much better in that metric. But Square more broadly, certainly a much more stable company than I would say. It's been around longer, much larger company. Who knows? Maybe TOST is a company that could end up holding a candle to something like Square in the restaurant space, but specifically since they do niche down into restaurants. But your big risk factor is how many small businesses can you actually convert to a payment processor? One of the red flags that I actually think of as well is if you have a net retention rate of 110% for these payment processors, it's a sign that you're able to continue to sell to your existing customers. And really what you have is a land grab. You have a land grab trying to get as many restaurants as you can to use your terminal. But what I want to know is how difficult is it to take a small business restaurant that already has a terminal, Like maybe they're using Clover, or they're using a different terminal. How hard is it to convert them? Are you going to have to substantially ramp your advertising rate to continue to get the same kind of growth? To me, it's too competitive of a space. And I get nervous over the fact that it's going to take a lot to rip somebody away from a different payment servicing company if they already have a payment servicing company. They're going to have to be very discouraged with cloud-based servicing by the other companies. So that makes me nervous. I feel like now we're kind of like in the easy land grab. And sometimes I wonder, like, are we IPOing now because the easy land grab is slowing down? But hey, at the moment, their growth is still running. So maybe not. But that's what I would be paying attention to at Toast, is can we really justify a $30.5 billion valuation when we've got a company that is in a land grab for positions in restaurants? They're not appealing to chain restaurants because the chain restaurants are making their own. How many restaurants can we really get? We calculated about an 11.5% market share. But how many small business restaurants right now are already using a smart, or should I say cloud-based POS, versus how many more can we actually get? And then when we have to get into the converting phase. And so that's a risk factor for me. I don't necessarily see a crazy unique selling proposition of Toast versus maybe like a Clover or the other. So I imagine a lot of these things will come down to nuance. And I think that kind of explains why the search trends for like the Square POS, the Toast POS, the Clover POS, these are all relatively similar. Now, in fairness, when you type in Square POS, you're comparing to all sorts of payment processing terminals, whereas people typing in the Toast POS are really just specifically looking for Toast. Same thing with Clover. You can use Clover for small business, whereas Toast you're really just using for restaurants. So I certainly would say they're probably one of the leaders in restaurants for small businesses, but competition galore in this space. So yeah. Anyway, so okay, folks. Right now it's an island grab. The land is shrinking. Oh no. Anyway, so these are some of my thoughts. I think it's very high for what it is, and it's not something that I would buy. I don't want to bag on the company though. I'm sure they do great things. I'm sure their terminal is beautiful and does great work. But I think there's a lot of hope getting built into this. I mean, even if just very quickly to leave off on this on sort of a very rough projection, say we got to $3 billion of rev, and they were able to bring 15% to the bottom line, okay? Fiserv's at like 23%. 15% would be a lot by 2023 for them to bring to the bottom line. Let's just do a quick little look at that. 15% would be about 150 mil, 10%, no, I'm sorry. That'd be about $450 million. 450 million divided by, in 2024, we've got 499 shares. 450 divided by 499. So if they grew at a 30% clip, they got to $3 billion in revenue, and then they were able to take 15% to the bottom line, you would be getting about, which at $60 divided by 90 cents per share, you're paying about 66 times for 2024 revenues. For a payment processor in a very competitive space, with my opinion, not like the biggest moat, and the shrinking kind of potential land grab, it's a little rich. Would I pay 45? Maybe. 45 times, that'd probably be somewhere around like $42 or something like that. That's probably where I'd be a lot more interested, which, ironically, just realized that's actually kind of where the underwriters priced the thing too, at $40 for IPO. So some of my thoughts. Thank you folks so much for watching my thoughts here on Toast. I hope you appreciate it. And folks, we'll see you in the next one.